Hey, I would love if you would. I think, obviously we have so many friends and network in common, but I think especially on the banking side and the community banking side, I think there's a lot of people that aren't familiar with you that should be. And I'd love if you you got a really cool background, and I think everything you're doing now is super interesting, and we've got a lot of connections and friends there as well. And so if you want to just take a couple of minutes and give a little backdrop, that'd be awesome.
You got it. You got it. Yeah. So I guess the shortest version I can give you is I left school at 16 and spent 8 years doing software engineering, writing code that put mainframe data on a .com from 2000. So I'm dating myself through 2008. Turns out that's a really useful skill if you ever get into financial services to know how MQ messages work and how mainframes work.
Mhm.
Uh, in 2009, I got a job for a company that's now based in Columbus, Georgia, called Thesis, but I was working in the United Kingdom. I worked in their data center doing project management of all things, because it turns out, whilst I understand software engineering, I can't spell. I'm dyslexic, so my code doesn't compile, but I'm really great at problem solving. And sometimes I'm okay at communicating, but it's mostly the British accent. Um, do
That was awesome.
And then I spent a couple of years there, and I started to recognize the basic shapes and colors. But I was really fascinated by the emergence of fintech. Like, I was following this fintech thing, and I would email it internally. And instead of like firing me for being noisy, they created a job for me as head of innovation. I did that. And my job was to come up with new products, sell it to the first client, hand it to the sales team. And the first one we did that with was a mobile app. So we were the second mobile app to launch in the United Kingdom in like 2010 for Capital One. We did that project. And then I was recruited by Barclays to come do payments change for those guys, lead a lot of what they were doing on the corporate banking side. And then payments change generally, I got close to the SEPA implementation, the PSD2 implementation. Like, I'm working with all of the different payment systems, getting much closer to core banking. I had my mainframe backdrop, and I did that for a couple of years until the CTO asked me to help set up Barclays Rise and Techstars, which became their like startup outreach and VC arm. I was then briefly head of crypto R&D. So I did a lot in like 3 years. Enjoyed all of it. And then left in 2016 to co-found a company called 11FS, which did media and podcasts like FinTech Insider. But we also worked with everybody from Stripe to Grab Financial to, First National Bank of Omaha and everyone in between. So did that until 2022 and joined a little company called Sardine, where I'm now the head of content and some of the strategy stuff we do. By day, I also run a blog called FinTech Brain Food, which is a weekly newsletter with more than 40,000 subscribers, where I just rant about the state of the industry, having been there and seen it and delivered it from the inside.
Man, let me say something real quick. Oh, I'm such a fan. So many people that have a voice have never built anything, or they claim to have built things. But if you look at the track record, it's actually a history of building failure. And to see people that have, just to say, been in the trenches, oh, it's a breath of fresh air. And the rant, man, I love it. That's one of my favorite things. I want you to go on a rant today with us and tell us the things that are, hey, I'm pissed off about this. I'm really excited about this. Here's the favorite, coolest interview I ever did. Here's the stuff that scares the shit out of me. There should be plenty of that for all of us, right? But there's also a message of hope in here too that's pretty exciting. So
Yeah,
those are
and
my
like
questions.
that's kind of my shtick. We can make this better. Like, this really annoys me. What if we did this instead? That's kind of the rant. It's like, and also like, because I have been an operator, as the startups call it, because I've worked inside large organizations, small organizations, like, I know where you are. And I know sometimes you need a little bit of hope. And I know sometimes you just want to scream into the void. And I'm saying all the stuff I used to say when I had a day job and nobody gave a damn. Now I'm saying it with an audience and people think it's the best thing since sliced bread. But
There
like,
you go.
I love it.
so that this is for everybody who has the day job that feels that way, that get catharsis out of it.
One of the
That's
things
right.
I've been thinking a lot about this recently. It's funny, our backgrounds are somewhat similar, right? I was in that, call it 2010 and App Store life, and it was like the world freaking changed. I really feel like we're on the cusp of something transformationally similar, right? Looking at if you went back, let's shit, 15 years to kind of remember it was challengers, right? And loan
Mhm.
marketplaces. Okay. And then fintech really evolved. And then obviously you've got bank tech right on this side. And they kind of ran in parallel paths for a long time. And then BaaS and sponsor banking began to, in small circles, bring the world back together. But I think there's a lot of friction, right? I think a lot of the more fintech crowd has looked at bankers as being old, tired, and sluggish. In a lot of ways, that's truth. But in a lot of ways, you got to understand the regulatory environment and
Yeah.
things like real time where there's a reason for batch. It may not be the greatest of reasons, right? But we have some reasoning here. And so I think those two worlds have kind of looked nastily at each other. And now there's beginning to be a lot of mutual respect. Those worlds are getting closer together. And I kind of have this feeling right now that we're looking at some combined new world in the future, right? It's all just banking. You know what I mean? I'd love to
Yeah.
get your thoughts, man. Am I crazy? Does that make sense to you?
No, did you ever watch the movie Blade with Wesley Snipes?
Yeah.
Oh yeah.
Do you know how like he was the vampire that could go out in the sunshine? He was a daywalker,
Dad,
right?
how
So
many
I
times
think
have I
that
said
there
this?
are the emergence of daywalkers, people that can be among bankers and can be among fintechs and don't have to be one or the other. Like in defense of nuance, like you're both right and you're both wrong. Like it's that you can learn a lot as a banker from how a fintech company uses data and how they automate and how they really can manage risk in some interesting ways. As a fintech, my goodness, the amount of work that goes into making a ledger just add up is unfreaking believable. Errors, breaks, like wrecks. I've lived it. I've lived end of day batches, and it's not fun, right? So the basics of financial services ledgering actually is really, really hard. And when it goes wrong, we see what it goes wrong. So we can learn from each other. I do think it's starting to come around the other way because everybody's realizing we kind of need each other. And when anything matures in financial services, it realizes that we're frenemies, not enemies. That we'll compete hard over here, but we have to do business over here. And that's the reality of a complex world. At Barclays, I used to go to Cybos every year. If you've never been, this is like where Chase does a deal with Citi and HSBC does a deal with Barclays, and like they all figure out like, okay, you've got this bit of territory and I've got this bit of territory, and somehow we need to make international wires work. How the heck are we going to make that happen? We're going to do a deal here and we're going to be each other's clients. That's kind of playing out. You see it a little bit in fintech versus fintech as well. It's like, oh, you know, Brex versus RAM. And actually, they're both got different parts of the market. They both have different approaches. It's not versus, it's like us versus shitty customer experience. Let's go fix that.
Yes. I think on the bank side too, this is a little strange, but if you just looked at the BaaS environment, this banks versus fintech, it's like we're gonna have folks that are good at charters, regulation, compliance, and compliance as a service as a topic, to the technology folks that know how to acquire customers, right? And et cetera, et cetera. And those have always, I mean, just like me, man, you walk into enough software companies and play enough of those games, and these are wildly different departments. How come out in the marketplace we look at these as competitive? I mean, hey, this is just
So
different
this,
sides of the world.
so this is the part where the old guy comes in the room. It's like, yeah, I mean, I may be the coolest old guy as far as tech and all that, but there's a side of me also that's like, we all need to, let me say it this way. I love innovation more than anybody I've ever known. I think it's the greatest thing. And I mean, man, there is a hype around that. There's a feeling, a vibe around it, that every time you get together with, a bunch of, let's say entrepreneurial companies, venture funded, they're badass, tech guys, and they're innovative. I mean, it's intoxicatingly cool. That said, we have to keep in mind we're doing brain surgery here. We are talking about the US banking system. We're talking about the world currency. This is not us and Europe should be the same. This is completely different, of what you're playing around here with something that could kill us all. So we have to stop playing catch with the nitroglycerin, right? This could blow up everything. So at a moment in time, there needs to be that part of the conversation that we have to have a clear vision, not a, hey, let's go, man, it's cool, let's go experiment. Yeah and no. And you had written something that grabbed me, just grabbed me, about venture debt, basically venture debt risk, not, venture capital, the debt thereof and the risk that goes associated with that. Man, I want you to rant on that one.
The private credit is probably like the biggest threat to bank deposits, and more than anything, bank lending, right? Like private credit is getting into not just forwarding of lending. It's getting closer to originating. There's marketplaces, and in the US in particular, it's strong. It's big everywhere, but in the US, my goodness, your Apollos, your Blackstones, your KKRs, they are seeing that Basel III is their opportunity, that especially the smaller banks do not have the net interest margin to be able to compete. But what they were great at is that niche lending, that specialist lending. And actually, can they go partner with somebody who's not a bank to distribute some of the private credit that's in that space? But there's an issue, right? Like, private credit has done really well. It's been on an unbeaten run, like 10% year over year, but it played in its window. And it's getting outside of that window now, and there are strings attached. And I gave some examples of where, a venture-backed startup also has venture debt, and the investors lean on them knowing that they've got that debt and that's senior to the equity, and they use that to create outcomes. Like, there's dirty games that can be played against smaller companies into lenders that I'm not saying it doesn't happen with banks, because banks have got to risk manage, but they typically come from a different place, which is like, are you profitable? Okay, let's do business. Not so much this other world where there's just like power games going. So there are risks with the private credit space.
Exactly where I wanted you to go with that. That it's both on the consumer side, it's also on the commercial side, and it's getting bigger all the time. And this is an area that poses a serious risk, because we've now, like you said, we've taken the specialty side of this and seeded it out, basically, because we can't be competitive on that side. Man, keep going. I love this topic.
Well, and if you're thinking about embedded finance, right? Embedded finance, embedded banking is like the opportunity for deposits. But the FDIC seems to think that they're all brokered no matter what they are, and it's the savings and loans crisis, and we're in the 1980s. And I'm like, I'm sorry, but there's like, you're confusing what happened with SVB, which is a whole other thing, with what happened with Synapse, which is getting ledgering wrong, which is like a whole other thing, with the savings and loan crisis, which is a whole other thing, with embedded finance, which has its unique risks and challenges. And if we look at that for what it is, there are unique risks and challenges, but there are also competition. Private credit, I think it's Triple Point Capital was one of the creditors for Synapse. There's another private credit fund that's just been acquired by a larger organization that was distributing and originating in the fintech space. Embedded finance is something the market wants. There's a lot of pull for, like, how can I just get lending where I'm doing my daily activity? Don't make me walk into a branch. Don't make me go to your mobile app. I just want it to be here where I already am. I want it in my operating system. Great. Here you go. Have it. Now, who's manufacturing that? Is it a bank's balance sheet, who is responsible to their state or federal regulator for safety and soundness? Or is it a private credit fund who's trying to manage returns on behalf of investors that does not have the same regulatory oversight? Not that I'm saying what they're doing is going to go wrong, but what I am saying is the regulators don't seem to care, because nothing's gone wrong yet. And that always worries me.
Well, and the thing that I kind of, again, not to try to sound like the same person in the room, because I am really excited about all of this and I dig it. And we thoroughly, granularly understand this entire game. But it needs to be said occasionally. What you're talking about right now is the funding and the risk of not being funded, right? Okay. These companies, I'm not going to say institutions, but these companies, they do not have capital requirements. They don't have liquidity requirements. There is a risk associated with them. And then when the company owns the actual, let's say, client deposits, and they can bundle those clients up. This is my app. These are my customers. I own them, and I'll take them where I want to go. That is part of the problem. I think if a bank, we've got to get back onto the banking side of the system, or we're going to have to regulate the other side of the fence, which is a disastrous move.
And it's fair to say that the overwhelming majority of embedded finance is still happening on a bank's balance sheet today. It's like 99.1, 98.2, but that too is growing, right? Like the percentage is shifting and the market is shifting, and private credit's got to find more market from somewhere, because it's had an incredible run. How does it keep going? How do we keep this party going? So they're looking in every corner, and their opportunity is the loss of the specialist lenders, the specialist banks, and the specialist institutions. To your point, the regulators won't do anything until something must be done. Regulation is what happens when something must be done. We need a crisis before regulation will come in. So we've just got this like regulators in the post 2008, post SVB mindset. Banks, safety and soundness, banks. I don't care about that. It's only rich investors that are going to lose out. Well, is it? If it blows up, actually, everybody loses out throughout the
That's right. That's right.
I'd say in a lot of ways, though, look at the theme of broker deposits, and then think about SVB, digital bank runs. The embedded finance model, in a lot of ways, I think at least the three of us would agree, there's a lot more safety and soundness. There's a lot less flight risk, liquidity risk, right? We've talked a lot recently with, the FinPro folks about a lot of these relationships look like contractual deposits. There's a little bit of time value to that flight risk, right? And so there's really good opportunity. If you looked at commercial banking, and I've kind of been preaching this one recently a lot, let's say, 900 or so in the US, nearly 20% of that group, that's your BaaS banks, your 144, I think, as of today. That's the space. So it's like, if we just sat down and said, this is the evolution of commercial and treasury, and that's where the embedded finance flow comes from on the chartered side, this makes so much sense. It's actually really simple to think about. And what do those commercial clients look like? And let's say on, the slightly larger side, that's your grocery stores, your gas stations, that's Uber, that's Home Depot, that's right, all these kinds of folks. That is wide open running field that I think from a regulatory standpoint, everybody's comfortable, at least in a way that we could all understand it, as opposed to the other side. That's why I use the challenger word, Simon. I think it's tongue in cheek these days, but I think it makes everybody uncomfortable, the abrasiveness between banking and fintech. Whereas if we thought about commercial banking and the extensibility of embedded finance to a commercial client, I'm a lot more comfortable. And I think everybody is, because it's more understandable.
Yeah, I think one of the reasons regulation tends to get copy pasted is because people embed what they're doing in their experience, and innovation looks the same as risk, and risk looks like innovation. You can't tell the two apart. And innovation is inherently risky, but that's why the blast radius of anything you do innovative should be small. It's also the fastest way to learn. So how do I keep that blast radius relatively small, and how do I grow it with time? And I think that point on the deposits look a lot like commercial deposits or consumer deposits. Yeah, I mean that's proven. Go look at the banks behind Cash App and Chime and all of those sorts of guys. Their deposit balances may not be as high as like a direct deposit coming out of a consumer's main bank account, but the stickiness is pretty good and the consistency is pretty good. So you have to, one of the things regulators say is same risk, same regulation. Well, the first part of that sentence is broken because it is not the same risk. Understand what the risk is closest to, and then apply the regulation that would apply there. Like, don't get me wrong, I do think that, like, especially looking at this as a Brit and a European, the like zoo of regulators and the like pinball game you have to figure out how on earth that you're going to regulate this embedded finance thing that financial institutions have to. It's a nightmare for everybody involved. Like, nobody's winning. It's not the fintechs, it's not the banks. Everybody's just trying to figure it out. And the wrong answer is, screw it, we're just going to go execute. No, like you got to figure out how to come correct in this space, but it is hard. Like the zoo of regulation is just it's really, really hard. The lawyers are going to be busy on this one for a while.
Well said.
Well, the thing I kind of stress to people is it may not be perfect, but it is, if you take layers and layers this way, it completes a safety net, right? And we've got an overlay of this stuff that's worked pretty well. Let me say it this way. It's worked better than any other system in the world, and it's done it better than any other system in history. It may not be perfect, and there may be room for improvement, and it is definitely reactionary. You throw something into that net and it throws it back up. That's what we fix. Whatever bounced off of us hardest, whatever works, that's where we go on the regulatory front. Now, that said, man, you're right. It's complicated, but it's not an excuse because it's complicated to go out here and break it. Likewise, where you see opportunities, when you guys were talking just a second ago about, commercial side or whether it's, credit, I agree with you, man. Lending is something that's so easy to take away from banking. And anywhere that you smell the potential to take the largest pool of money ever, which is the US banking system, and take something from that, that's where the VC dollars are going to go.
Yeah.
It doesn't mean that's where they should go. And here's what I'm trying to say. Hey, man, I hope they do good. I hope they win. And I hope there's a bank behind them that makes $1 zillion and this is the future. That's awesome. If it's done correctly, if it breaks the US banking system, it's not fucking worth it. That's what I want to say out loud. It's not worth it, guys. We've got a responsibility that comes along with this. And I think risk and innovation, man, I love it if it was a sandbox, but we're not playing in a sandbox any longer. And we're actually in the real world. And when we talk about they're going to change the rules on broker deposits, man, I couldn't disagree with that any more than the rest of the world. I mean, most everybody's like, what the hell are we doing that for? Because it doesn't solve the problem, y'all. If you want to go around, what we're all really trying not to say is that, hey, fintechs are really not insured by FDIC, and we've got risk all over the place, and we need to figure out how to ledger that directly back onto the bank core, just like it was a customer of the bank, but we'll subjugate them into a little corner and subledger on the bank side. This is where we all need to go, and we all need to get our arms around that. Subledgering on a company out there is almost like a reseller for the bank.
Yep.
That you want to treat those like this. At the end of the day, our innovation and our ideas and everything else, throw it out the friggin' window, because what's going to happen eventually, enough people, in this last case, 200,000, enough people are going to get hurt, the consumer, by this. There will be an absolute backlash that crush all of us, crush innovation, crush all of this, eliminate risk. What regulators are famous for is not measuring and applying regulation. They go, wham, this hit me in the face. What do I have on the shelf? We've got this awful thing that we couldn't get through before, but now we can. And it over-regulates. And this over-regulation absolutely snuffs out the candle of innovation. We don't want to do that either. And that's what we are creating right now, all of us, is the potential to have a backlash, a pendulum swing the other way that just slaps the shit out of all of us. We don't want that either. So there's a middle ground where I think what I want to scream to the planet Earth is there are responsible adults that understand this zoo and also understand the needs and risks and how to innovate and how to create. Let's get those smart people in the room. And again, I want to invite you again, come to the roundup. You're welcome to come. Happy pay your way. I mean, love having smart people like you in the room. Can I ask one more question and change the topic?
Yeah, go right ahead.
I would really you've interviewed and talked to so many smart people. I don't think there's any doubt it makes anybody smarter the more you, how long can you talk to Elon Musk before your IQ went up, right? And, even a dummy like us, it's like, man, you pick up a lot of stuff, right? And I just wanted to hear you talk about how much you've learned from your guests. What were the most interesting things and topics and interesting people?
Oh my goodness.
Right.
I recorded the FinTech Brain Food podcast where I had like the CEO of Ramp and Brex and Mercury and many, many others. But I've bank CEOs and everything, a bit like yourself. One, a podcast is a great excuse to talk to people, and two, it's just sitting at the learning tree because you're asking people questions. So you're taking something from it every single time. But the thing I cannot get out of my head is the interview with the CEO of Ramp, Eric Lyman. One, he'd worked at Capital One and he'd seen inside the challenger that got big. He'd seen inside the culture that was still led by a founder, but was a massive organization. He'd seen how data can drive just a different way of thinking about risk, that sort of insight-based scoring. But he also said something else that, and this is the one that really stuck with me, which is focus a lot more on the input KPIs than the output KPIs. So the output KPI is revenue, is deposits. Those are all the things I want, right? Those are the outputs. The problem is there's no way to measure that until you've got it. Whereas the inputs, if I can work all the way back to the things that create deposits, that create revenue, then I know what conversations to have with the different parts of my organization. So with a sales team, I can talk about how many calls you got booked, what's blocking you from getting more calls booked. With a product team, I can talk about what's your shipping velocity like, what's blocking you from getting shipped, sort of what's your feature tag looking like. With a customer team, I can talk about where's our customers hitting friction, like what's slowing them down, what's hurting our onboarding. So if you focus as a CEO on the inputs that you know create the outputs, then you solve your company equation. And I was like, oh my goodness, he's solved the equation of hypergrowth in financial services. But also, if you look at them as an organization, they partner aggressively on the back end. So it's let a bank do what it's great at, let other companies do what they're great at. What we focus on is that customer experience at the front and making expenses just work, making AP just work. That's where we're great. That's where we want to play. And they are driving incredible growth for that. So I think that's kind of one of those examples of what you could build, of what you could do. That really, really stuck with me.
Man, I tell you what, we need to get together and create something on our end, huh?
Yeah.
I'm kidding.
Hey,
Because that's
quick.
literally what we do all day long. But man,
Oh, yeah,
I love that stuff that you catch from people. And I mean, I think what I kind of heard in that right there was that figure out how to capture the customer and what processes would actually enhance that to capture more customers on the front end. That's where your dollars are eventually going to end up from.
The top of the
Yeah,
funnel, man.
it's that, but it's also like get underneath the little things that cause them a problem anywhere. So it's retention side
Right.
as much as anything. Let me give you an example. I had an issue. So Ramp has this really cool feature. Let's say that you have built a company expense, but it goes to your personal email, not your private, not your company email. Just because, I don't know, maybe you set up an account or whatever. Now, normally that receipt, you could print it out, you could take a photo, or you could forward it to your company email and then forward that to the guys over at Ramp, and then they'll automatically collect all of that. And they go, hold up, we got you. Just tell us what your personal email is, and you could just forward it directly from that. So instead of having to forward the email to my business account from my personal, I can just forward it directly to receipts@ramp.com from my personal email. I got in touch with them and said, that feature doesn't work for me. And within like 30 minutes, I'd got a reply from the CEO who said, oh, yeah, no, we figured out what that was. Your account was associated with another company you worked with back in the day. We fixed that for you.
Nice.
Actually, the fraud catcher is what fixed it for you. Wow.
It was the CEO who went deep on the like, this is going to be the thing that's causing a little bit of friction. We've figured out the exact root cause of your friction and we've removed it, because everything is about like, how can I save you time? How can I save you money? And by saving people time and saving them money, they can get on with whatever there is in their world. And I think fundamentally that's a service mentality that we got away from a little bit when people stopped walking into branches.
You bet.
I love it.
I love it, man. Hey, look, I have enjoyed the heck out of it. I want to give you a minute though. Any final thoughts, man? We covered a lot of cool stuff that was pretty comprehensive, but anything else on your mind, man?
Just that scams are gonna get worse before they get better. RTP is coming. It's one of the reasons I joined Sardine, right? I often say I'm from the ghost of fintech future and financial services future. The UK, we had RTP in 2005, and the short story is the scams get worse from here. And it's not
Real-time
just
fraud.
Zelle, it's every rail. And it's not just a Zelle problem, it's an all of us problem, right? Because scammers have realized that with digital, with mobile, they can do a scam from anywhere in the world. And even though Reg E says you're not technically on the hook in some readings of it, that's going to go through the courts. Public pressure is going to come the other way. Like, you need to get your scam detection in order. You need to come correct on that. I think that's going to be a bigger and bigger topic as RTP, push to card especially, really becomes much more common in a lot of institutions. So I think that's my final thought.
That's a
Reducing
real-
friction and fraud, right? Making it easier for fraud. We'll push the card.
It's a balance. So I've really enjoyed this, guys. Thanks for having me. If people have enjoyed listening, I'm on fintechbrainfood.com. Check me out. But like, this feels like I've come home in a lot of ways. This was so fun.
Awesome, man. We enjoyed the heck out of having you, and look forward to catching up here soon, buddy. We'll see you next time.